Good morning and welcome to another edition of Account-Based Friday. First of all, I want to appreciate and thank you for investing your time in 30 minutes. We're going to be talking today about growth benchmarks and KPIs. If you're watching real time, this conversation is as much for you as it is for us, and it's your opportunity to ask questions. So if you have a question, drop it below and we'll promote the question up. And just to kind of orient you, my co-host Meg and I, Meg Hewer, who formerly ran Serious Decisions Research, she and I have been running this for better part of 3+ years. In the upper corner of the screen, you'll see a QR code that'll bring you to 300+ YouTube videos of best practices around go-to-market strategies. We'd encourage you to like and subscribe to it if you get value out of today. And today, just like we've had other special guests, we've got a unique guest joining us early morning from San Francisco, Ray Rike. Now, if you don't know Ray, he's the founder and CEO of Benchmarkit and founder of SaaS Metrics Standard Boards. I can't think of a better person to talk about growth and KPIs, particularly around SaaS, than Ray. Ray, we're super excited to have you join us today. But we're going to give you kind of some airtime in a few moments. What we typically do is we start each week with a poll, and this week no different. And this week's poll, we're asking a question around benchmarks, coincidentally, to line up with our guests. And the question is, where does your team perceive the value? And I use the word perceive because sometimes companies see things different ways. I just fielded the survey this morning, so not a lot of votes yet. So it'll probably be collecting over the next week. But so far, it seems to be breaking very much toward the external side, which I happen to vote toward. But Meg, did you have a point of view on this?
I did. I was kind of wishing there was a third option, actually, which is both. But I picked external to your point about perceived value. I think most people want to compare themselves to others that are not in their company. But I think the power of a benchmark comes from understanding what others are able to achieve, the range of what others are able to achieve, kind of highs and lows, and then also comparing your own performance. And that came from, kind of my time at Serious Decisions. We found that really high performers actually struggled with external benchmarks because they might be doing so much better. So the only people they could compare themselves to were the best of the best, or themselves. And then, but if you kind of shift that and say, I'm only going to compare myself to myself, you might not realize what good looks like, right? And what's possible. So I think there are great use cases for both of these. And Ray, super excited that you are, carrying the flag for really putting together high quality, comprehensive benchmarking for all things SaaS go-to-market. Really excited that you're here today. Thank you for joining us. And what are your thoughts?
It's a passion. I think it's both. I think it's very important to understand your, number one, to put in the infrastructure to measure those performance metrics that are most important, not only to your department, but to your company. Do they have a causal relationship to the company metrics that investors care about? Things like Rule of 40, net revenue retention, your CAC payback period. So definitely measure it yourself. Look at your internal trends. Try to do that always by customer segment, because if you're focusing on SMB, mid-market, and enterprise, they're going to be very different, so you should know those. But then compare it to the external benchmarks. But the caution is, don't look at general population benchmarks. They really can mislead you. At a minimum, be looking for benchmarks that are segmented by not only company size, but by average annual contract value. A simple example is CAC payback period. It's going to be much different for a 5K ACV product than a 75K. So use benchmarks, but make sure they're segmented. And benchmarks are not gospel. They're not a target. They are guardrails and guideposts for directionally where you want to be heading. But you also need to understand that any particular metric has to be in context of your corporate strategy and your other metrics. What do I mean by that? You may say, hey, growth rate right now is the most important thing. I got to hit 40%. And I'm going to sacrifice a little bit of customer acquisition cost efficiency to hit that 40%. Knowing that when I need to, I can turn the dial and become a little bit more efficient. So just look at benchmarks in context of your corporate strategy.
Yeah, Ray, you brought up something really, really important, and I'm so glad you did. And that is, it's having a huge number of people as part of a benchmark is actually a bad thing unless there's truly and really a huge number of companies that look just like you. So your point about having a really relevant and appropriate peer set is so important. I think back to my time at Serious Decisions when we might show somebody a peer set of 8 or 10 because that was the appropriate peer set for them. And then they would say, oh, but I got this other benchmark report and there's 200. Why is yours so small? And all we needed to do is say, well, did you take a look at who was in that peer set? Because suddenly they'd realize they were being compared to companies that, to your point, had a completely different cost structure, product offering, go-to-market motion. And there's really not a whole lot of value in looking at that. Now, I think comparing, understanding different kinds of go-to-markets and saying, oh, well, what's possible over there, even though we look different, knowing that it's different is the key. But thank you for bringing that up. How do you counsel people when they start to think about what the right peer set is?
Well, we use something called R squared. So we try to understand the correlation. It doesn't prove causation. I won't get into all the boring statistical stuff, but between one independent variable and one dependent variable. So an example, I mentioned CAC payback period or CAC ratio, which is a customer acquisition cost efficiency metric. It's more correlated to ACV than it is to, company size. But then you have something like net revenue retention, NRR, also known as net dollar retention. It's actually much more correlated to pricing model than company size, because usage-based pricing is typically going to see a higher NRR. So those are just some examples. Always look at it by at least ACV, company size, ARR, pricing model. Those are the three most important.
I think you bring up a great point on kind of the segmentation, and Meg, your kind of journey as well. I think we've got three different viewpoints here. As a former operator, I was the one that made the mistake. So I'm a finance undergrad. I'm passionate about numbers. I got all excited about benchmarks, and kind of on the other side of the table, they're like, but this isn't our business. And so this was very early on when I was a very green CMO, bringing that to my CFO, bringing it to the CEO. Over time, I kind of learned, the process of selling in the benchmarks on those different elements that you mentioned. So I think that's a great call out. As you're diving in here to kind of the CAC and NRR, maybe starting from the top, like what should be the key KPIs or metrics like a CRO or CMO should be articulating to a CFO or a CEO? Because you're probably working more at the CEO and CFO level, but what do you think is meaningful from an overall metric? Like what should we be tracking?
So I've put together this SaaS performance metrics framework that are segmented or categorized into 5 primarily pillars of enterprise value creation: capital efficiency, operational efficiency, customer acquisition efficacy, customer retention efficacy, and customer expansion efficacy. Now, what I did was I created a CRO performance metrics framework that what are the top 5 metrics you should be measuring that have direct correlation to what you investors care about, your CFO, CEO, and board of directors. So number 1 that we put is CAC ratio. How much sales and marketing investment are you making for every dollar of new logo ARR? That's new CAC ratio. For every dollar of existing customer expansion CAC ratio, ARR, that's expansion CAC ratio. And combined for every dollar of total new ARR, that's blended CAC ratio. So CAC ratio is number 1 in my book for a revenue leader, a CRO. Number 2 that I look at is your growth rate, because growth rate right now is being valued at 2.5x more towards enterprise value to revenue multiples than operating profitability. Now, the caveat of that is you can't be growing at any cost. You still need to have some minimal operating profitability measured by EBITDA or free cash flow, but growth is 2.5 times more important. So Any CRO who's measuring and thinking about Rule of 40 is world class. Third, I do put net revenue retention in the top 5. And the reason I put net revenue retention is that has acquisition, retention, and expansion. And that's the way a end-to-end CRO should be looking at. And you should understand that NRR is now the number 4 metric that impacts enterprise value to revenue multiples. So that's my third for a CRO. I actually look at customer lifetime value to CAC. Now, that's not an operator metric. That is a compound metric, right? But what it does right now is this, maybe I can spend a little bit more on customer acquisition because customer acquisition costs are up about 40% over the last 2 years. So even in a time of efficient revenue growth, our cost to acquire customer and its related ARR is up over 40%. So I like to look at customer lifetime value to CAC because I can justify to my CFO, yeah, instead of spending $1.50 to acquire a new dollar of ARR, I'm spending $1.80. But based upon our high GRR and our ability to expand those relationships, I'm delivering a 5-to-1 lifetime value to CAC, customer acquisition costs, versus the industry benchmark, which is between 3 and 4. So those are the 4. And then the 5th that I'm a big fan of is I say never present NRR if you don't know your gross revenue retention number. Because you can have an amazing multi-product portfolio, an amazing expansion motion in place, but if you have a leaky bucket syndrome, that instead of only losing GRR measures the percent of ARR that's maintained year over year, excluding upsells, 86 to 88% is a good kind of median. But if you're at 81%, you better get that leaky bucket fixed before you keep throwing more capital into getting new customers. And by the way, secret insight here, GRR is an amazing metric to include in defining your best ICP. A lot of people think your best ICP is who do I close fastest, what's my highest ACV. Those are good input signals, but if you can't keep them 1, 2, 3 years down the road, it may not be your best ICP.
Yeah, that's great advice. Thank you. I think all of those things are incredible levers to be able to pay attention to. And in particular, as you said, looking at, not just who you win, but who you keep becomes, I think, the way to build that sustainable, predictable revenue flow. But before we jump into another question, we actually got one from Maury, who is wondering about that external peer set. And he is correctly pointing out that finding generic stuff out there in the universe gets harder as you try to be more relevant in terms of your peer set. What are some recommendations you have if people want to get better benchmarks?
And more, I'd ask you to also put in, is there a particular type of benchmark? Are you looking at financial performance, marketing metrics, sales metrics? Just put that in there. So there are like 6 or 7 really good sources of benchmarks in the B2B SaaS industry that I recommend. In fact, if you just do a search on SaaS Barometer newsletter, best benchmarks, I kind of highlight those. So I'll start with Iconic. Iconic Growth is a VC firm. They do a great job on go-to-market metrics. Like they just put out marketing productivity and budget benchmarks, really good. They do great GTM series. Insight Partners also has some really good data on go-to-market benchmarks. So those are 2 VCs I really like. I would put in David Spitch and BenchSites for public financial metrics. I really like what Emergence Capital did for SaaS financial performance metrics last year. So those are 5. And then I have to plug Benchmarkit because my whole goal over the last 4 years was to build the largest, broadest, and most contextualized benchmarking database. We've collected data from over 25,000 B2B SaaS companies. We segment everything by company size, ACV, pricing model, go-to-market motion, even target customer segments, enterprise, mid-market, SMB. And we have about 22 different data sets. You can go to benchmarkit.ai and find those. As an example, and I was talking to John and Meg right before this, I just partnered with Carrie Lou Dietrich, the former CMO, and it took Atlassian public, John Miller, the founder of Marketo and Engagio, and also Bill Masitis, who was the chief marketing officer at Zendesk and then Slack. We just collected marketing budget and productivity metrics from 300 SaaS companies that we'll be publishing next week. And we now know things like what percentage of revenue is being allocated, not only to marketing, but how is it allocated between people and programs and technology. An interesting data point, just to throw it out there, product-led growth companies, that's another segmentation variable we use, only spend 22% of their marketing budget on people versus 44% for sales-led growth. And correlated, they spend 20% more on programs. So that's the type of data that I think is really valuable. I hope I answered the question.
Yeah, no, you definitely answered the question from my perspective. And it looked like Maury chimed in. He was looking for marketing metrics that came to mind in terms of, I don't know if that alters anything that you want to add there before I ask my next question, but I'll just ask, any changes based on what you just shared there?
No, I would ask Maury, just, feel free to follow me on LinkedIn. As soon as we're ready to publish the latest B2B marketing budget and productivity benchmarks in about 3 weeks, we'll make sure we let you know.
Yeah, no, absolutely. And, you bring up a good point about the survey that you're doing. And I'm thinking about kind of the macro environment here where we're trying to stuff 10 pounds of things into a 5-pound bag of the go-to-market cost structure. From what I read, is bloated right now in the eyes of CEOs, boards, meaning it's costing a whole lot more to acquire customers. And then on the flip side, sales and marketers are kind of forced with two things. It's what I call the grow 20%, increase your budget by 2% syndrome, where marketers, we like to spend and invest money because we know we can get a return, but we're being told grow more on less. And then on the sales side, I'm also hearing quotas doubling randomly, just this year, or this past week, of saying, guess what, your quotas are now going to double for next year. So how does the math here? Where do you see this headed? Are those the same trends that you're seeing, or are you seeing anything different? Where does everything kind of work out math wise here?
Well, John, you're talking about the magic of Excel budget models. I'll talk about the reality of experience from 2024. So during the period of efficient growth, we went from spending $1.31 of sales and marketing to get $1 of new ARR to $1.62. So over a 30% increase. The public companies, the big guys, the best of the best, your Harvard and MIT grads, they went from spending about $1.41 of sales and marketing to get $1 of net new ARR. Net new ARR, a little bit different, being new ARR minus churn and downsell ARR. That's net new ARR. They went from that $1.41 to $2.10 over the last 2 years. So almost a 50% increase. So the reality is customer acquisition cost per dollar of new ARR have went up. The good news is sales and marketing expenses over the last 2 years, it went down about 6% at median. It used to be about 43%. Now it's 35%. However, here's the beauty of benchmarks, John and Megan. I looked at growth rates across 936 private companies last year, and I segmented by investment in sales and marketing. Would you believe it that the companies who invested 50% or more of revenue in sales and marketing grew the fastest? And the companies that spent 25% of revenue or less at median grew 10%. Now, I could use that data to say, give me more budget. See, it's proven, but you've got to have some predictability in unit economics over the last rolling 4 to 5 months to go justify that, right? If you're not being efficient, you can't go ask for more money. But if you've got some proven unit economics for customer acquisition, for customer expansion, go get more money and you'll grow faster.
Out of curiosity, does that look different for services businesses versus product businesses? Did you look at that at all, or were you primarily focused on product businesses?
Yeah, 95% of our data, Meg, is from B2B SaaS and technology companies, not services. So one of the things I'll never do is provide commentary on something I don't have data to back it up.
And I appreciate that as a former analyst. With that in mind, you mentioned those are a couple of kind of interesting surprises or unexpected findings. What are some others maybe that you could highlight for us that you think would help for, in particular, marketing leaders to pay attention to?
And with marketing leaders, I'll get to in just a minute. But one very interesting thing over the last year and a half, 2 years, we know how hard it's been to get new logos, right? It was really hard. Thank God that I'm not out there doing a lot of customer acquisition anymore. But so people said, okay, we got to retain our existing customers. So I'm going to spend more money on that. Probably a good strategic decision. But for those who had a cross-sell or upsell motion, they said, let's spend more focus and more money on expanding existing customer relationships. Here's the result. So net revenue retention, which measures, retention plus expansion, went from a median in private companies from 105% to 101% last year. So it's down 4%. Now, people could say, yeah, but if I hadn't made that investment, it'd be down to 98%, which is fair. And public SaaS companies, net revenue retention at median went from 120 to 110%. But here's the thing that blew me away. It's something called expansion CAC ratio. How much expense did I incur in my sales, marketing, and customer success organization that was allocated to existing customer expansion for every dollar of expansion ARR? 21, 22, 23, it was about 69 cents per dollar of expansion ARR. Last year, it went up to $1, a 42% increase. So what happened was companies said, I'm going to invest a hell of a lot more in existing customer expansion, but they didn't have that repeatable, scalable, efficient motion. So one recommendation for everyone today is measure how much sales, marketing, and CS expense you're investing in expansion ARR motion, and just try to get better, right? Try to get better, make it more efficient. Now, from the marketing perspective, honestly, this survey we just did, we had 309 companies actually participate. About 230 of the participants, we could really use their data because they weren't outliers, it wasn't bullshit, right? The thing we saw there was a lack of measuring the efficiency of your marketing spend. The top three measurements are pipeline generated, right? Number of opportunities generated, and new ARR generated. So that was good, right? At least it's more aligned to an outcome metric that investors care about versus number of website visitors, number of MQLs to SQLs, et cetera. However, less than 26% were measuring marketing expenses to generate $1 of qualified pipeline or $1 of new ARR. So yeah, we want to know what the outcome is, but we need to know what the efficiency of the outcome is, because I can't go to, as a CMO, go to the CFO and say, I want to spend $5 million more on marketing in the next 2 quarters. Okay, Miss CMO, how much qualified pipeline are you going to generate? I don't know. You don't know how much marketing you spend per dollar of pipeline? How much new ARR? I don't know. That's the answer in 74% of companies. So really start measuring the efficiency of your marketing investment and your sales investment, by the way, as measured against the ultimate outcome, which is dollars of pipeline and dollars of new ARR. Did that answer your question, Meg?
It did indeed. And I think you bring up a really important point that is something I actually just published a post on this week, which is the fact that very often marketers are measuring things that boards and CEOs and investors just don't care about. And we've trained them to think the only thing they can expect from marketing is a volume of leads. Right. So if your chart doesn't keep going up and to the right, regardless of the size of your addressable market, you're doing it wrong. Well, that's crazy, right? What you just talked about is a much more important measure. And all of the different metrics that you just talked through, CAC ratio, things like that, all become, I think, really important for marketers to know and to track if they're going to have any prayer of being seen as a meaningful part of the go-to-market engine. And to your point, to be trusted enough to get the budget they need to be successful, like those big public companies that were able to invest more and win more. So I think, what you're bringing up is a really important point. What would you say on the sales side of things? What's an interesting observation you'd have for CROs and heads of sales?
Well, most heads of sales, and I'll use head of sales versus CRO because in my world, a CRO should have broader responsibility. They classically are going to measure your win rate, your sales cycle, your average ACV, because all of those go towards, are you making quota? Of course, quota productivity. Those are all really nice, but a couple of things I see us missing. And number one is the fact that only 50% of people, AEs, are making quota. That in itself is an issue, right? But I would work really closely with your head of marketing as the head of sales to say which segments, which ICP, to use the new trendy term, right, is really generating the highest quality opportunities as measured by that conversion rate to close one, so win rate. Where's my pipeline coverage ratio the lowest? And which of those are generating the largest customer lifetime value? If you're a VP of sales and you're thinking about that, you're more likely to become a CRO, number one. But number two, you're not going to be so focused on the short-term wins that you neglect the near-term win for your stock options, which is enterprise value.
Just you've given us so many nuggets here throughout the conversation, but in the last 6 minutes, it's like, holy cow, there's a ton to unpack. First, just building off of what Meg was previously sharing about her post and somewhat self-serving, but we spent a lot of time on the measurement of different account-based and go-to-market motions in Salesforce. And I would wholeheartedly agree with what Meg is saying about focusing the marketing efforts more toward the pipeline, more toward volume and velocity, and figuring out how to measure that and getting everybody on the same page, which that's a body of work and why we've got a business. But I wanted to go back to a comment that you made very early on about the retention and expansion. And I don't remember the name of the metric that you mentioned, but I just wanted to double click on that a little bit further and try to figure out, okay, so if I'm a marketer, how should I be thinking about expansion going into 2025? Because a lot of marketers now are being asked by their boards, it's not just about growth, it's about what can you do about retention. And it goes back to the leaky bucket thing that you said earlier on. If your bucket is leaking, you got to work 3 times harder on the new acquisition versus the retention or the upsell. But it sounds like you've got some new analysis there, and I just want to really drill down a little bit further on that metric and kind of the thought process of how marketers should be thinking about things.
Yeah. The one interesting benchmark that's trending very differently over the last 3 years is the percentage of total new ARR that's been generated by expansion. Now, it also is stage appropriate, right? So I'm going to make a comment that's not the same for a $1 million company as it is for a $50 million company. But it used to be thought, you hit 20 million, you should be around 70% of your ARR growth should come from new customers and 30% from existing. It's changed. It's now 60-40. And once you hit $50 million and above, the benchmark is closer to 50-50. So if you're the head of marketing and you're a company that's getting closer to 20 million, you should start looking at your marketing investments and motions for acquisition separately than from retention and expansion. You might even want to dedicate resources, dedicate your spend, measure it that way, and start showing to your CFO and CEO, here's how much I spent on growth marketing or new customer acquisition. Here's how much I spent on customer or retention and expansion marketing. Here's the pipeline I built for each. Here's the conversion rate for each. Here's my CAC ratio for each. But start thinking of them as 2 discrete segments, measure them as such. Because that way you can, when your CEO comes to you next year and says, hey, we need to grow 10 million, you're going to be equipped to say, well, based upon how we're trending, we should look at 48% of that coming from growth, from existing customers. Based upon our history, we're going to need $3.2 million to invest in pipeline development for existing customers to deliver X%. But when you have that discussion with the CFO, she looks at you and says, can I see the data? Wow, that's really good. it's much easier to get the budget. So
yeah, you're so right on about that. And I think it's, unfortunately, I think because of our overdependence on thinking about lead volume being the only measure that matters for marketing, they aren't always invited to the table when it comes to that investment in, I would argue, both retention and expansion, right? Not just expansion, but marketing's toolkit's really good at helping customers stay with you. But being able to find metrics that articulate that in a credible way for CFOs and other members of the executive team, I think has been really hard. So I appreciate that you are building not just a vocabulary or highlighting a vocabulary that exists that I think not many marketers are using, or not as many as could, but also providing them with some benchmarks to understand what good looks like. So I really appreciate what you're building and what you're doing, and the way that you're coaching, the people in our go-to-market world kind of make better use of their metrics to help them do a better job. So thank you for that, Ray.
I'm going to leave it with one thing, which is a little bit different. I was listening to Dave Gerhardt and Chris Walker, who are two of my favorites in the industry, right? They were on a podcast together yesterday. So I recommend everyone, after you listen to this one, go listen to the Exit 5 podcast. But I'm talking about all these more demand gen kind of efficiency metrics. Strategy and brand awareness is critical. So if you want to start a podcast, start a new YouTube channel, right? My recommendation to you is measure what percentage of your pipeline is coming from inbound leads. Know the performance metrics of those inbound leads, close rate, win rate, et cetera. And then if you're going to invest $100,000, couple $100,000 in some content or media, measure what percentage of your total pipeline is from inbound leads. If you're doing great brand and content marketing, you're going to see that percentage go up from 20% to 30% to 40%. Now that's going to be longer term paybacks, right? It's going to be minimum 2 to 4 quarters. But once you start saying, and by the way, the average B2B company today is expecting 40% of their pipeline from inbound leads. If you're under 40%, if you're at 20, brand and awareness might be your best investment, but you got to tell your CFO how you're measuring that return.
Excellent, excellent advice. Thank you. And I'm going to go check out that podcast.
Awesome. So just keeping an eye on time here. I think we're just at time. And Ray, I really want to thank you for coming out. I guess any parting thoughts, Meg, from your part on today's conversation?
No, just again, thank you. And knowledge is power for, for all go-to-market leaders, but marketing leaders in particular. And I think acquiring some of the vocabulary and the comfort with benchmarks and measurement across the spectrum of what Ray shared is time very well spent for marketing leaders right now. So thank you again, Ray.
Yeah, Ray, really appreciate you coming out early morning and sharing your wisdom, and really looking forward to those new benchmarks in a couple of weeks. And thanks for giving us a little bit of an appetizer there. I'm really excited. There were so many nuggets today. I'm going to go back and listen to this again. So a lot of value. Next week, just building on what we shared here today, we've got Hunter Montgomery, who's a CMO. We've had Hunter on before. He's the CMO of Churn Zero. So he will be joining us as a guest, and we'll be talking about all things related to what we just asked that question about, the expansion, the retention. Hunter will have an interesting point of view on that as well. And somebody said he just joined late. Bart, yes, there is a posted video. So I'm glad you asked this. If you go to YouTube and search B2B Fusion, you'll see under the live comments that there is a video. I'd include the link here. In fact, I'll drop it in here as well. But on LinkedIn, you'll also be able to see it. But if you go to YouTube, you can go right now, and it'll tell you where the video is, and you can look at it that way as well. So with that, Ray, thank you again, and we'll look forward to seeing everybody next week.
Great weekend, everyone.